Hey guys, welcome to Fiscal Policy Part 4. In this video, we're going to talk about multipliers. The idea that when the government changes its spending or when taxes change, that we don't just get the immediate effect of the spending or tax boost, but there's spillover effects as the money goes around and around the economy, creating more economic activity than the initial amount. So yeah, let's get started.
So I want to start with just remembering from the beginning of class we had a circular flow diagram, and I'm going to stick with the closed economy version of it. We can complicate it later, but that would mess with our multipliers I'm going to show you today. So let's start by remembering the players in the circular flow diagram. There's households and firms, and these two entities interact in product markets and in factor markets. And the way it works is that firms supply goods and services in product markets, which make their way over to the households. And in return, households make payments, money, going from the households through the product markets to the firms. On the other side with the factor markets, households supply land, labor, and capital to the factor markets, which makes its way over to the firms. And in return, firms will pay rent, wages, and profit, which eventually makes its way through the factor markets back to the people who supplied it to begin with. Now, in the middle of all of this is the government. And the government gets involved in every part of this. We have government being involved by taxing households. And I wrote net taxes so I can avoid the whole issues of redistribution and transfers and all that. And in return, they will provide goods and services to the households. And there are certain things the government provides for us that we get from them. The government can spend money in product markets buying goods and services, and those goods and services make their way back to the government. The government can collect taxes from firms, and it also can provide goods and services to the firms. The government can spend money in factor markets buying land, labor, and capital, and in return it'll get those factors. And the government can get involved in any of these places to whatever extent it wishes. So how does this help us to figure out the multiplier effect? Well, I'm going to show you two different versions of how this could be. One of them, let's say the government decides to increase government spending, expansionary fiscal policy, and they're going to buy a bunch of stuff in product markets. So they will increase their expenditures. And that money is going to make its way to the firms who produce the product. Those firms receive that money, and they have to hire more workers and other resources in order to keep production up. That money works its way over to the households who collect more income. And in those households, what do they do with that new income? They can go buy more stuff. And where does that money go? It goes to the firms, who now they have to make even more stuff for the increased demand from the households, and so they have to hire more workers and stuff. And then they get more money, and around and around and around it goes. So that's our first round of the multiplier, our first look at it. We'll formalize it a bit in a few minutes.
Let's look at a different version though. Let's talk about taxes.
Let's say we do a corporate tax cut, and so these net taxes decrease. Well, when that happens, firms are going to turn higher profits, or maybe some other form, but they're going to be able to give more money through these factor markets that eventually makes its way to the households. Now, in the case of it just being higher profits, it would be specific households, the ones who own the firms, but you get the idea. Those households will buy more stuff, which means more money makes its way to the firms. And then we get this round and around process again. The cool thing about the circular flow diagram is it helps us to see how, if the government changes any of this, or this, or this, or this, it will have a multiplier effect, because it was whatever they change is going to go around and around and around in the economy. And we can do it negative also, of course. For instance, what would happen if the government cut spending or cut the services going to households. Well, then the households don't get as much stuff, they're not going to spend as much, they're not going to receive as much, they're not going to pay as much, they're not going to, and then multiplier making everything worse and worse. It goes both ways. So with that in mind, let's formalize this just a little bit more. Let's talk about the multiplier effect itself. The multiplier effect is a change in government policy creating a bigger change in GDP. The fact that the initial change can repeat itself over and over means that the eventual change in GDP will be more than the initial change. Our simple model assumes that our marginal propensity to consume is constant for all citizens and that there are no leakages, such as what might happen if we spent some of our money overseas and it stopped cycling around our economy. We can add those later, but I'm not going to do that to you in a principles class. So let's start by saying that there are two multipliers, one associated with each of our fiscal policy options. So our first multiplier is the spending multiplier, which we will call M with a subscript S. And there's another multiplier, which is our tax multiplier, which is M subscript T. So let's go through the spending one first. Let's go into some pretty good detail. Example, we're going to assume that MPC is constant at 0.6 and that the government changes spending by $1,000. Added $1,000 of spending. Well, the immediate effect is GDP goes up by $1,000 because GDP is C plus I plus G plus net exports. Well, G went up by 1,000, so does GDP. So that's our first big impact on our GDP. Then, income just rose by $1,000, so the change in consumption is the MPC times the change in income, 600, because that's equal to 0.6 times 1,000. But if consumption went up by 600, someone else collects that as income, and their income went up by 600. There's the second round impact on GDP. Then, change in consumption, again, is 0.6 times 600, which is 360. So change in GDP is $360. There's your third round, and so on. It just keeps going and going and going. We call this the multiplier process. Now, side note, we can calculate this if it went on forever without leakages as a geometric series. It's a lot like what we did with our money multiplier, only the MPS is equivalent to the the RR in that. So our spending multiplier is 1 over 1 minus the MPC, which, remember, that's like saying 1 over MPS, which would be equivalent to 1 over RR in the money multiplier if you made that connection, but whatever. Now, what do we do with this multiplier? I would tell you change in GDP will equal the multiplier times the change in spending. So your change in GDP will be 1 over 1 minus MPC times change in government spending. That is our relevant equation. In the case where we had a 0.6 MPC, that's your multiplier, 1 over 1 minus 0.6. And we changed government spending by 1,000. Well, then our change in GDP is 1 over 0.4 times 1,000, which is 2,500, because our multiplier was 2.5. Now, a quick side note, just for the heck of having a different example, if we were to say government spending were to decrease by 2,000, what would we do? The multiplier would still be 1 over 1 minus MPC, so our change in GDP would be 2.5 times negative 2,000 would be 5,000. And so we see these multipliers at work. Smaller changes in government spending having bigger effects on GDP. Now, let's go to our other multiplier, our tax multiplier. We'll do something similar. We'll assume that the MPC is 0.6, and we'll decrease taxes by $1,000. Well, the immediate effect is that disposable income rises by 1,000. Note, I put the D on it because production or total income hasn't changed, just disposable income. What does that mean? Disposable income is actual income minus taxes. So, our change in consumption, however, there will be a change in consumption because we have more money in our pockets, is 0.6 times the change in disposable income, which is 600. which means our GDP rises by $600. And this is the first round of increase in GDP. Then, consumption will rise because income rose. So 0.6 times 600 is 360. So GDP is going to rise by 360. There's the second round of GDP increase. And then consumption rises by 0.6 times that, $216. GDP rises by $216. There's a third round. Something you'll notice is that the numbers start to repeat themselves. The second round in the spending multiplier process looks the same as the first round in the tax multiplier process. The third round in the spending multiplier process looks like the second round in the tax multiplier process, and that will go on forever. They're exactly parallel except for the very first round of the spending multiplier. So let's talk about what that does now. This is another geometric series, but without the first step. And so our tax multiplier is going to be a little bit smaller because our first round is smaller and every round is smaller because of it. So our tax multiplier is going to come out to be MPC over 1 minus MPC. Now, the idea is still the same. So our equation is that the change in GDP is equal to MPC over 1 minus MPC, the multiplier, times, oops, I forgot the negative. Don't forget the negative, guys, it'll mess you up. Change in GDP is equal to negative the multiplier times the change in taxes. Don't forget that negative. Why not?
Because taxes affect GDP in the opposite direction from government spending. And so in our current example with the $1,000 tax cut,
times change in tax was minus 1,000. So this is going to come out to be, let's see, negative 0.6 over 0.4 is 1.5 times negative 1,000. And those negatives are going to cancel out, and it's going to be 1,500. So cutting taxes by 1,000 raised GDP by 1,500. Now, we could do a different example. I could say, note, if change in taxes were equal to 500, then our change in GDP would be negative 1.5 times 500. GDP would fall by $750. One thing you're going to notice, these multipliers are different from each other. 1 over 1 minus MPC versus MPC over 1 minus MPC. The spending multiplier will always be bigger because MPC is less than 1. So the spending multiplier will always be bigger because it starts with a direct increase in GDP. Whereas the tax multiplier starts with an indirect thing. It starts by changing disposable income, not production or income, which then affects consumption and then affects GDP. It's less direct, and so it has a weaker start. The spending multiplier will always be bigger because of that. But yeah, I think it gets us exactly where we needed to be. I hope it was helpful. If not, too bad. But thanks for watching, guys. Happy econing.